Friday, February 23. The copy near this video goes into more detail, but as I look at the overall situation that we're in, we're now in a Fed tightening cycle. And it's not just the first little one and then sort of see what happens. We're in one that's going to be every 90 days or so, or every 120 days. The Fed's going to come maybe 3 times this year and then do it again next year, do it as long as necessary. We haven't been in a situation like that since 2004. And from my vast perspective, that was yesterday. But as I thought about it today, that means that anybody on a trading desk who is much under 40 has never lived through a Fed tightening cycle firsthand. And I thought a little more about that. And we're also looking back at a decade more, a dozen years now, of the best Fed leadership, arguably in its history and maybe in the leadership of central banks anywhere, which the Bernanke and Yellen era brought stability, predictability, wisdom, which is extraordinary. That we have a brand new Fed chairman now who's rookie, and so are several of his colleagues, both Fed governors and presidents of regional banks. This is first time at the show. And then there's the investor world as well that hasn't ever been through this. And so it seems to me that no matter what actually happens in terms of inflation or not, or growth or not, or whatever, to have quite so many rookies loose on the plantation at the same moment, I think it may be exciting. It may be a little uncertain from moment to moment. But so as not to alarm. Some other stray pieces of news drifted by. Now, the risk at hand is that the Fed, with models that are predictive, not predicting anything, or predicting things that didn't turn out to happen. The Fed is data dependent. It's going to have to react to every news item as it appears. The risk is on the upside for the moment, that especially the effects of this tax bill and other federal spending. The federal deficit in 2017 was a little over $500 billion. It will be over $1 trillion next year, which, at least in Oklahoma, is double. The stimulative effects of that sort of thing at just the moment when the economy may wind up overwhelmed of its own accord. Here are a couple of things that have transpired that modify those risks. One of them, the first big repatriation of foreign earnings, is beginning to take place. Cisco brought back $67 billion on which it must pay taxes. And it couldn't think of anything to do with the money except to buy back more Cisco stock. Of all of the investments available to Cisco Systems, none of them are worth doing. Which says the stimulative effect of bringing money back in from overseas may not amount to a lot. Also, Warren Buffett, the greatest investor of our time, will release his Berkshire Hathaway annual letter shortly, and it will mention that Berkshire Hathaway has $100 billion in cash, taxes paid. And Buffett says that he can't find anything worth investing in. Not in the equity markets, not internally at Berkshire Hathaway, and just sit on the cash. So adding more cash by fiscal stimulus may not stimulate anything. It's not easy to imagine why that might be so unless you look at the world as a whole and consider the vast overinvestment by China. China desperately trying to ramp its economy up at the same moment that its workforce begins to nose over. At least the trained portion of the workforce, the reserve labor in the countryside, is huge. China wants to invest like crazy to elevate their standard of living. Well, China yesterday seized the largest insurance company arguably anywhere, Inman, which some analysts have at 2.5% to 3% of Chinese GDP. Inman's chairman had been on a binge for years of buying overseas assets in an effort to get money out of China. He owns the Waldorf Astoria, for one thing. Well, Chinese officials not only took over Inman, but they arrested the chairman, and he's in jail. And if events in China hold true, he'll never be heard from again. Which makes me think that the miscreants in the United States in 2008 who escaped scot-free should give thanks that it wasn't in China, or we'd never hear from them again. But that Inman matter means that as China pulls in risk-taking by its entrepreneurs, that means a lot less funny money from China overseas, here, pulling back on significant stimulus. The rise of Emperor Xi means that China, instead of being a source of risk in the world, is all of a sudden the most powerful stabilizing agent in the world. Because Emperor Xi is intent on de-risking the Chinese economy and getting it out of the credit craziness internally and externally. And those things are good news. So, a lot of rookies running around, but for the most part, there may not be anything for them to run into. Do have a good weekend.